This presentation is geared towards mid-career people and even new hires, and really to highlight the great benefits that you have, not only for retirement, but flexible spending and all sorts of other good stuff. So I appreciate you taking the time, and share this with your friends if they didn't have time to review this with you. So we're going to go over our main retirement plan. Guys, we have 9 retirement plans, but 90% of our folks are in our main retirement plan. So that's the one that we're going to focus on today. We're going to talk about planning for unexpected events. We're going to talk about 4, 5, 7 deferred comp plans. I'm going to just do a small overview on member self-service, because that is the place where you can go out and do, oh gosh, all sorts of things, benefit estimates. You can run purchases out there just to get an idea of what it might look like. It is a great place for you to be self-sufficient. And then we're briefly going to talk about some of our other NDPERS benefits, such as flexible comp and other wellness benefits. Okay, so let's debunk some myths. First of all, one myth that we often see is that people think they're only going to need income in retirement for 10 to 15 years. Well, we've all got the memo that we're living longer, and a lot of folks spend 20 or more years in retirement. As a matter of fact, we see some people that have been retired in our system for like 30 years. It's crazy. So you need to plan for 20 or more years in retirement. A lot of people think that their living expenses will be a little bit lower in retirement. I don't know what you're cutting out. I mean, I don't plan on buying dress clothes anymore. Maybe you're thinking you'll have less gas because you're not driving to work, but gosh, a lot of people are working remotely already. Inflation's going to erode your purchasing power. So you probably, when you're putting together your budget, you don't want to cut out too much. And a lot of times people think Social Security is going to replace your pre-retirement earnings and it won't be taxed. Well, the truth of the matter is that it's only a partial replacement. And there's a very strong possibility that 50 to 85% will be taxed. That depends on your income. Now, that's a question that you would need to ask to Social Security, because PERS does not administer Social Security. Okay, so let's look at this little pie chart. 25 years of employment. What we're assuming is that if you worked for 25 years in our pension plan, your retirement payment from us will be about 50% of your pre-retirement earnings. So how are you going to make up for the rest? You've got your Social Security, which is going to be about 30 to 40%. And then if you have additional savings, for example, a 457 plan or an IRA, that might be another 10 or 20%. So let's take a look at the defined benefit hybrid plan, or what we also call our main plan. Actually, it's a plan of many names. Sometimes we call it the main, sometimes we call it the DB. But this is the one in which about 90% of our folks are enrolled. This is a really important slide, the next few, to know which tier you are in. Our main retirement plan has 3 tiers, and which tier you are in is dependent on when you first began contributing into the plan. So if you began contributing prior to January 2016, that's tier 1. If you began contributing after January 1 of 16 through December of 2019, you're in tier 2. And anybody that began contributing January 1 and after is in tier 3. I want you to note that I'm using the word contributing, not hired, because let me give you an example. Let's say that I worked back in 2014 and I was in the tier 1 plan. I left employment and I decided to leave my money intact. I went off on another adventure and I came back, and 6 years later, I am contributing again. I've got a new hire date, but since I left my old plan intact, I'm grandfathered under tier 1. So what does your tier determine? It determines when your normal retirement date is. And let me explain what normal is. Normal means that it's an unreduced benefit. And normal You can get to be normal in our plan, which is kind of a cool thing, by either turning age 65 or meeting your rule, which is age plus service. And depending on your tier, your rule can be 85 or 90. Okay. A lot of people get really hung up on the rule. It's either turning age 65 or meeting your rule, whichever occurs first. The other thing that your tier is going to determine is which multiplier that we're going to use to calculate your benefit. We have a 2% and a 1.75%, and we'll look at those in a little more detail. And also whether or not you're going to have a health credit. Also, the reduction in percentage of your retirement should you choose to retire early. And you do have the ability to draw your benefit early, but we are going to reduce it for the rest of your life. Okay, so let's take a look at this table. Tier 1, Tier 2, and Tier 3. Vesting for all three tiers is 36 months of service. Vesting simply means that you are legally entitled to receive a lifetime benefit when eligible. Contributions. You can see that cumulatively the contributions are 15.26% in all three tiers. What you need to notice is that in tiers 1 and 2, 7% is going into an employee bucket. So like, for example, if you go out to member self-service and you're tinkering around and you're running estimates and you see an account balance, that's what you're going to see, your 7%. The 7.12%, which is the employer fund, you don't see that on member self-service because it's a big old bucket with all the employer contributions. And then 1.14%, which is funded by your employer, goes into a health credit bucket. So if you went out to member self-service, you'd see your 7%. You wouldn't see the employer pool, general pool of funds, or the health credit. And that's the same thing with tier 2. Notice in tier 3, 7% is still going into your bucket, but there's no health credit in tier 3. And the 1.14 that was going into the health credit is now being merged with the employer pool of funds. Okay, so tier 1. I can retire in tier 1 as soon as I meet my rule, no matter what my age is, or at age 65 is normal retirement. If I choose to leave employment before meeting my rule or age 65, then there's going to be a reduction of 6% each year I leave early. Tier 2 and Tier 3, same deal here. Now, if I leave early as age 55, though, my reduction is going to be 8% each year. The other thing you need to notice about normal retirement under these plans is that Tier 1 is either rule of 85 or age 65. Doesn't matter if you meet the rule of 85 and you're only 53 years old. Under Tier 1, you are at normal retirement. In Tiers 2 and 3, you got a little bit of a difference here. If I want to meet full unreduced retirement, even if I met my rule of 90 age plus service before turning age 60, I would take a reduction. So in order for me to get my full maximum benefit in tiers 2 and 3, I need to both meet the rule and be at least age 60. If I turn 65, I'm going to get my normal retirement too. Okay, so it's either the rule plus age 60 or turning age 65. And then lastly, if you look at the very last column, the multiplier. The multiplier in tiers 1 and 2 are 2%. In tier 3, it's 1.75%. So here's the benefit formula. Years of service. So every time you go to work and you earn a wage and it's reported to NDPERS, you get a month of service credit. Final average salary, highest 36 salaries averaged. Benefit multiplier, that goes back to the table. It's either 2% or 1.75. And when we multiply those three factors, it equals your single life benefit. Now, a lot of people don't understand this, and it's so cool to know, but your money never runs out in this plan. This is a lifetime annuity. And how does this happen? First of all, when we pay you your retirement, we deplete your member account balance. And when that's gone, we pay you the rest of your life from the general pool of funds. This is like the grooviest retirement plan ever. Let's talk about unexpected events. I think these are really important for our active employees who maybe have a ways to go before they retire, just so you know what some of these options are. And I would encourage you to share a lot of this information with your significant others, just so that in the event something were to happen to you, they would know what some options are. So let's talk about survivor benefits. Here's the assumption. I'm not receiving my retirement payment yet. Okay. I'm either still actively employed or I have left employment, but I haven't drawn my retirement. If I am a single person, whether I'm vested or not vested, my beneficiary or beneficiaries will receive my member account balance paid to them. If I am a married person, but I'm not vested, then my spouse, if that's whom I've named, and they've signed off on the beneficiary designation, is going to receive the lump sum. If I'm married and I'm vested, remember vested is 36 months of service, but I'm not at normal retirement, meaning I'm not 65 nor have I met my rule, then we're going to offer my spouse, we're going to calculate the benefit upon the date of death, and we're going to offer my spouse 1/2 of my single life benefit for the rest of their life. Of course, they can always cash out. Now, let's do a third scenario. I am actively employed, or maybe I should just say I'm not drawing my retirement benefit yet. I'm vested and I'm at normal retirement, and I've just been working a little bit longer. I could have retired last year, say, and I die. Then my spouse, we're going to calculate benefit upon date of death, and we're going to offer my spouse 100% joint and survivor benefit for their lifetime, or of course they can cash out. So it's really important, I think, for especially married folks to let their spouse know that there are survivor benefits, because it's a terrible way to find out what your choices are when they're under duress. And typically, it makes the most sense to take a lifetime benefit. And so just so that they're aware that that's an option. Okay, this is a big one, designating your beneficiaries. Guys, if you go out to member self-service, you can see who your beneficiaries are for your retirement plan. If you have our NDPERS life insurance through Voya, you can see who your beneficiaries for that are. And I got to tell you, this is a huge deal. We see this periodically where folks that are married may designate their spouse as 50% and their 2 kids as 25 and 25 as primary beneficiaries. Their spouse signs off on it. And guess what would happen? If you died because your spouse signed off on that, we wouldn't be able to offer them a lifetime benefit. We would have to pay out your account balance 50% to them and 25% each to your kids. And everybody's, situation's different. I mean, it's between you and your spouse, but honestly, you may want to review how you have your beneficiaries designated. And especially if you're newly married, maybe newly divorced, any kind of life change like that, you more than likely, I guess, if you like your spouse, um, you may want to make them primary, maybe the kids contingents. Okay. But I do think it's worthwhile for you to review this information, and maybe even put it in your tickler file. Every year when we do open enrollment, I'm just going to review my beneficiaries as well. Life insurance. Now, in life insurance, your spouse is not required to be your primary. So in other words, if you name somebody other than your spouse as your life insurance beneficiary, your spouse does not need to sign off on that like they do for retirement. It's probably a good idea to, take a look at those beneficiaries from time to time. Another common thing that we see is that, often maybe somebody's got kids as contingents, and your kids get married, change last names, change their addresses. So it's not a bad idea to kind of keep an eye on that stuff and really check it out. But I really, really would want to encourage people to look for sure at their retirement and make sure that they've designated. You're not required to designate your spouse, but if you don't, as primary, they need to sign off on it. But you might just want to double check that. Okay. We're going to talk about disability retirement. This is one that people do not know that we have. And sometimes I'm not even sure if the employers know we have it. And so we always want to do a shout out to disability benefits. If you have 6 months of vesting, okay, so you have 6 months of reported wages to us in our retirement plan, and you become permanently and totally disabled, then you can apply for our disability benefit. The way we calculate the benefit is we calculate it as 25% of your final average salary. So for example, if my final average salary is $4,000, my disability payment would be $1,000. Now, this isn't short-term disability, guys. This is long-term disability. I'm permanently and totally disabled. Of course, we have a bunch of forms because, heck, we're the government and we like our forms. But you would fill some out. Your employer fills some out that describes your job. Your physician needs to complete their part. And then what happens is we collect all this information and it goes to our physician who reviews it and makes a determination. If you are deemed totally disabled and you're receiving a Social Security disability, send that letter to us because that helps our physician make a determination right away. Now, it could take, 2-3 months for a determination. So often what we'll tell people is if this is, not a sudden disability, if it's something that's been coming up, and you're maybe on family medical leave and you're just trying to, kind of stretch it out as long as you can, you may want to begin applying for your disability with us right away. Because, and then as soon as you're done, as soon as you're approved, you have to be off covered payroll so we can pay you. We're going to pay you back to the first of the month after your last month of employment. So we would back pay you. We're also going to be paying you from the general pool of funds. So remember your member account balance that you have? We're not going to touch that with disability. We're going to pay you from the general pool of funds. You're going to have to recertify every 18 months. And then finally, at some point, if you're on disability long enough, you're going to become normal retirement, meaning that you'll have aged up and now you've met the rule, or you turn 65. At that point, we recalculate the benefit using our retirement formula. We're going to go ahead and pay you whichever one's higher, disability or retirement. But then we're going to switch and we're going to pay you out of your member account balance. We're going to blow through that. And then when that's gone, we're going to go back and pay you the rest of your life from the general pool of funds. So, emergency things that you want to think about. We do have disability benefits. If you were to pass away before drawing your retirement, there are options depending on whether you're married, depending on whether you're vested, for a spouse to receive an ongoing benefit. And regardless of your status being vested or married or single, your account balance is your account balance, and that's going to go to your beneficiaries. Okay, so account balance and separation of employment. On our left, I am not vested. I do not have 36 months of service, and I am not age 65, because being age 65 automatically vests me, regardless of how much service I have. I'm leaving employment. Here are my choices. I can just leave my money intact and let it earn interest. And honestly, I don't think that's a bad plan, especially if you don't really know what you want to do, let it earn interest. This happens a lot. Sometimes people will withdraw their funds when they leave employment, and a couple of years later, they're going to come back to work for us or one of the agencies that have our plan, and they're going to be subject to the new plan rules, whatever those might be. And then they're going to say, well, heck, can I buy the service back? And we say, we sure can, but it's going to cost you a lot more than what you got refunded. So I always tell people, if you don't if you don't need the money right away, just let it sit there. But if you choose to withdraw it, you can, either cash it out, or you can roll it over elsewhere, or you could do a combination of the two. Right side, vested. I'm 36 months or I'm age 65. Boom. I am legally entitled to receive a lifetime benefit when eligible. So what this means is, so let's say that I can draw right away. Of course, I'm going to do my retirement paperwork. But let's say I'm vested, but I'm not at normal retirement yet, and I'm going to go do something else with my life. I can defer drawing. Okay, so let's say that I've got 15 years of service in, and I'm going to go do something else, and I'm not ready to draw it until I'm age 62 or whatever. I can go ahead and just defer drawing my retirement. You can always draw early if you meet the eligibility for early, but it will be reduced. By deferring it until you meet your normal, you're waiting longer to draw it, but you're not taking a reduction. And of course, if you decide you don't want that lifetime benefit, you can always refund your account by rolling it over or actually getting it paid directly to you. Okay, purchasing service credit. This is something that I encourage people to look at. A lot of times people will talk to somebody in the office and they'll say, oh, it's just so darn expensive, and blah, blah, blah. And, I'm not going to kid you. Yeah, it's costly, but you need to do your own work and see what are the benefits and, what are your pros and cons. And so what's really neat about this is, you can go out into member self-service and just, poke around and run some purchase information. It's going to spit out a number for you. The information you guys get in member self-service, it's no different than what we're going to supply you. You're pulling from the same data that we are. The thing with a purchase, though, is if you decide that you really want to move forward, then you've got to send a request for and I'm air quoting here, the big formal one from us. But you can just play with your numbers out there. So why do people buy time? Sometimes they do it to vest earlier. Because let's say, for example, I just started working. I've been here a couple months, and I worked previously for the state of South Dakota. I have a year of service with them. I can buy that previous public service with them. I can do that right away, and that will help me get vested in our plan sooner. Sometimes people want to buy time so they can get to their normal retirement date sooner. Sometimes people just want to buy it and they're going to work till their normal retirement date anyway, but they're just going to boost or beef up their retirement because they've added more service years. Because remember, our formula is years of service times final average salary times benefit multiplier. So anytime I have more years of service, or if I have a larger salary, it's going to increase my benefit, right? And then if you're eligible for health credit, okay, which would be tiers 1 and 2, then it's also going to impact that, because health credit, guys, is determined as $5 for every year you work. So if I buy, 5 years of service, then I've got, $5 for every year I've worked, right? Or every year I've bought. Okay, so you can buy different kinds of service. Once you're vested, remember, vesting means 36 months of service or being age 65. I can buy up to 60 months of generic service. I don't have to buy all 60. I can buy in increments till I get to 60. Maybe I only want to buy 20. Who knows? When I'm leaving employment, I have an option to convert my unused sick leave and buy that. I also, while I'm working, if I have previous public service, such as military service, leave of absence while I was, maybe I had a medical leave of absence where I wasn't contributing those months, I can buy those back. Let's say that I have, like in my previous example, I worked for a different state, say state of South Dakota, and I want to buy that service. If I had federal service, legislative service, I can buy those. Common question we get is, you mean I could buy all this stuff? Well, yeah, heck. If you had 48 months of military and you wanted to buy that, you could buy that. If you had a year of service with South Dakota, you could buy that. And then in addition, you could buy the 60 months. And then when you leave, you can buy the unused sick leave. So whatever you're eligible for, if you have these types of services, you can buy them. Anybody, once they're vested, can buy 60 months of generic. Anybody can buy unused sick leave when they leave, okay? Now, the cost to purchase the service, you guys, is going to vary by everybody. And the reason why is because we use factors such as what's your salary? How close are you to retirement? How old are you? And then it pops in some actuarial figures. So my cost for a year is going to be different than your cost. And so the only way, and I don't even want to spitball what it would be because, it's all different. That's why I would encourage you, if you're interested, go check it out in MSS, Member Self-Service. But one thing that I really like to encourage people to do is if you run a purchase in Member Self-Service, and you get your dollar amount, then go out and run an estimate with the purchase and without the purchase. Then what I like to do is say, okay, how much is it increasing my benefit? How much is it costing me for my purchase? How long most people want to know, how long does it take me to recoup my money? I think the better question is, if you spent that, if you didn't purchase time and you left the money in whatever investment you have, how's it doing for you? Is it producing a lifetime benefit for you? What's it earning? So let's look at some examples here. So let's say that on the left, and this is assuming I'm leaving at the same time, right? Because I can purchase service to help me get out of work earlier. But in this example, what we're going to say is I'm purchasing service, and I'm going to leave at the same time regardless. I just want to buy 5 years to beef up my retirement. So on the left, no purchase. My final average salary is $3,000. I have a 2% benefit multiplier. I have 20 years of service. My single life is $1,200 a month. Okay, I'm leaving at the same time, but I'm going to add 60 more months of service. Now, because I have 25 years of service, look at that. My single life is $1,500 a month. I have $300 more in my pocket. So then my next question, and you can see with the hypothetical illustration on the right, is if I'm increasing it by $300 a month, and let's say hypothetically my 60 months cost $46,441.59, how long does it take me to get my money back? Well, almost 13 years. But honestly, again, I think the best way to look at this, and this is simply my opinion, is that if you had that 46,000 invested elsewhere, and you said to your investment person, okay, I'm going to retire, next year, and I've got this 46,000, and I want you to start paying me $300 a month out of this investment for the rest of my life. Can you invest it in such a manner that you can guarantee me $300 more a month for the rest of my life? So in a nutshell, that's kind of how I like to look at it when I'm doing pros and cons for purchasing. And I really want to encourage you to do your own homework on that. Go out to Member Self-Service, check it out. You can run these numbers all day long, and you're going to get the same data that I'm going to get. Okay, sick leave. This is really confusing for people. And by the way, we have a ton of lunch and learns on our YouTube channel. And I'm going to show you that after this presentation, where to locate these. But here's what's confusing about sick leave. It's one of those deals where you may or may not get paid out a portion of your sick leave per your employer contract. Okay, whatever your employer agreed on, that's between you and them. We don't really care at PERS because we're not making your payroll payments, right? That's a payroll function. But what we ask you is, how many hours of unused sick leave do you have? And so in our example, let's say I had 1,450 hours of sick leave. Now, let's say my employer, because I'm with the state and I've been here 10 or more years, they're going to pay me out 10% of it. That's great. Has nothing to do with what we're doing here at PERS, okay? We have some political subdivisions that pay out maybe 25%. We have other political subdivisions that don't pay out anything. Again, we don't care what your employer pays out. But what we want to know is, what is your total sick leave balance? Because we're going to do this little magical thing. We're going to divide it by 173.3. That's the number of working hours in a month. And then I'm going to come up with 8.37. I'm going to round it up to 9 months. And so getting ready to retire, and they say, hey, if you want, you can buy 9 more months of service. It's optional. Your employer is still going to pay out whatever they pay out per their terms. But if you want, you can buy 9 more months of service. So why would you do that? Let's take a look here. So if no purchase on the left, 20 years, and then on the right, I've added only 9 more months in. You see how it's increasing my benefit by $45 more a month. So I like to go back and do the same math, guys. If I take those 9 months, and I'm looking up here, if I take my final average salary times the 9 months times 15.26%, so in this case, 3,000 times 9 months times 15.26. Where's 15.26 coming from? That is the plan contribution rate. You are self-funding these months. It would cost you $4,120.20, okay? So I go back and I do the same math. How long does it take me to get my money back? You know, how long, if I had this money lying around in my savings account and I wanted to start paying myself 45 bucks a month for the rest of my life, how long could I do it? Typically, if you were buying, say, generics, a month of generic service and a month of sick leave at the same time, you're going to get a better deal on the unused sick leave purchase. You get the same month of service, but it's less costly. And it's primarily because of the way we calculate it. Remember, the other kinds of service, we're calculating using factors like, how old are you? How much do you make? How close are you to retirement? And then we pop in an actuarial figure. With sick leave, it's really straightforward. We take the number of months you're eligible to buy times your final average salary times the plan contribution rate. So if you have an appetite to buy service, I would for sure buy my unused sick leave and then maybe consider buying other stuff. Remember, with unused sick leave, you do not buy that till you are leaving employment. Now, I do want to mention a couple of things, since this is geared towards our new or mid-career people. And we do have some information on our YouTube channel about this as well. But let's say that you are going to switch to a different employer that still has our retirement plan, and your new employer is not going to accept your sick leave. Folks, you want to bank that with us in our system, so that when you do finally retire, you can go back and buy that time in anything that you've accumulated with that new employer. Because let's say not all employers have to accept all of your sick leave balance. Now, this is a time-driven thing. You need to do it within 60 days of transferring. But don't put that in your back pocket, that if you were leaving and going to another employer with our retirement plan, so it's a transfer, but your new employer doesn't take all your sick leave. Think about banking it with us, so that when you retire in 10 years, you can go back and buy those months of service if you want to. Okay, so let's do another quick example of unused sick leave with Tier 3, okay? So same deal here, basically just showing you the difference between buying a sick leave and not buying it, but in this case, you have the 1.75% benefit multiplier. All right, if you are interested in a service purchase, again, go run your own numbers. But if you decide that this is for you, then you're going to need to make an official request. And you can either do that by paper form, which is that request for purchase information 53718, or you can just request it through member self-service. If you decide that purchasing is the right thing for you, then there are multiple ways to pay for it. You can do a rollover from a pre-tax qualified fund. For example, if you have a 457 plan, if you have a 403B, if you have a 401k, if you have an IRA, you can make a plan-to-plan transfer to us. When you do that, it's going from one plan to another, so it's not taxable. If you are in tiers 1 or 2, there's going to be a health credit That's part of the purchase, and that always has to be paid with after-tax dollars, but that's a very small part of the purchase price. You can also make, well, I mean, you can always just write a check. You can also do payroll deductions. You can do before or after tax. Want to bring this to your attention. Let's say I'm going to do payroll deductions. We are going to charge you interest for that, by the way. But let's say you're going to do payroll deductions. If you choose to do pre-tax deductions, and then you have a windfall down the road and you say, God, I got a bunch of money I can throw towards this. I want to increase my payments, or I want to put another chunk of change down. You cannot do that when you're making pre-tax payments. You can only change the structure of the loan if you're doing post-tax payments, okay? All right. Next thing, and oh, and by the way, guys, I hope you're going to join us tomorrow. We have our TIAA 457 plan provider that's going to do a little ditty over the lunch hour. But this is what they're talking about: supplemental savings, our deferred comp plans. Now, if you are a state employee, we offer 5 different 457 plans. Some of our political subdivisions choose to enroll in some of our 457 plans. Some of our political subdivisions have their own 457 or 403B plans. All of those, though, under IRS code are considered deferred compensation plans, meaning you decide if you want to do it, how much you want to do. You can start, stop, increase, decrease anytime you want, and because it's completely voluntary. So you might say, I'm going to have my employer take $100 out of my paycheck every month before taxes, and it's going to go to my deferred comp provider. Maybe it's TIAA, our NDPERS companion plan. Maybe it's nationwide. I mean, you choose your provider. And then what happens is you and your provider work together to invest those dollars. Most of us are not really great with the investment thing. So it's really nice when you can hook up with the provider and kind of walk through some things. Normally, if they'll look at how old you are, what your risk tolerance is, and all that good stuff. But you're in charge of those dollars along with your provider. Okay. You can start it, stop it, increase it, decrease it at any time. Totally up to you. Now, why does a guy think about doing that? Well, remember at the very beginning when we had that little pie chart and we said this much is your pension, this much is Social Security, and that one little sliver, I think up to 20% was other savings. This is one of those other savings opportunities. And not only that, but if you look at just an example of a paycheck. So let's say that I make $4,000 gross a month and I do $200 in my savings, and I'm sending it to my 457 plan, my deferred comp, then you'll notice that my federal and state withholding is less because my taxable income is less. Because instead of 4,000 being taxed, now it's 3,800. So look at my take-home pay; it's 3,040. Now, let's say conversely, I go, okay, I make 4,000 a month. Go ahead and tax me on the whole 4,000. So they're going to take 800 in taxes out versus 760, but I'm going to put that 200 that's already been taxed into my savings account. My take-home pay is only 3,000. Now, you can choose whichever way you want to do it. Your savings accounts probably aren't earning a bunch. The benefit of putting it into deferred comp is because you're saving for the future. The risk, of course, is the market gets a little wonky, but I think it's worth investigating. What are annual limits? The IRS determines the annual limits every year. Okay. Now, the minimum that you can put into your deferred comp is $25. The maximum this year is $22,500 per year, or 100% of your taxable compensation. What kind of things are eligible for contributing to a deferred comp plan? Let's say you're leaving employment and you have a deferred comp plan and your employer is going to pay out your vacation and some of your unused sick leave. you can toss that into your deferred comp plan. People often think about doing that because when employers pay out vacation and sick leave, it's paid out at supplemental payroll, and so the withholding is higher. So sometimes they'll say, why don't you just throw that into my deferred comp plan? You can do catch-up contributions. So for example, if you're over age 50, the annual catch-up contribution is $30,000 a year, and that just means that you haven't contributed in the past, and now you want to make up for some lost time. The other thing is something called a regular 3-year catch-up. This year it's 45,000. Now here's the deal with this. You can only do that 3 consecutive calendar years before you leave employment, but you cannot do it in the year in which you're retiring. So let's say, for example, I want to do it this year, 2023, 2024, and 2025. I retire 2026, okay? I can't do it if I decided I wanted to retire in 2025. I can't do that 45,000 in 2025. All right. What happens to this deferred comp money? It's your money. It's always been your money. When you leave employment, we'd like for you to be off payroll for 31 days. You can do whatever you want with it. You can leave it where it's at. You can roll it somewhere else. You can take distributions. The reason we want you to wait 31 days is because we want to make sure that all your contributions have been received by, TIAA, Nationwide, Bank of North Dakota, wherever you're putting your money. And so the other thing though is, oh, and by the way, there's no 10% penalty before age 59 and a half on this plan. Unforeseeable emergency distribution. So let's say that I'm putting some money into my deferred comp plan. I got 20,000 in there and something really bad happens. And when I'm saying really bad, it's an unexpected event. So it's not your kid going to college. It's not getting married. It's not it's nothing that's on, because you kind of know those things. What I'm talking about is stuff like, well, we all remember the Minot flooding several years ago. It could be some medical expenses because you or a family member, a dependent, has become very ill. It could be anything like that. So a sudden unexpected event. This is a way for you to say, I'm still working, and I know that I'm not supposed to take out money from my 457 plan while I'm working, but I have an unforeseeable emergency. So you apply, and there's some paperwork involved, to our board who reviews your case. And if it's approved, then you can take a distribution. If you do that, you cannot participate in your deferred comp plan for about 6 months. The other thing is a small account balance. So if you have an account that's less than $5,000 and you haven't done any deferrals for 24 months and no previous distributions, you can get that. You can get a distribution from that. If you choose to enroll in your 457 plan with us, you can go on to member self-service, or you can fill out form 3803. We also have what's called a quick enrollment form, which is 54362, and that basically just lets you enroll 25 bucks a month with TIAA. If you're with a political subdivision and they don't have any of our 457 plans, check with your employer, because likely they do have some plans of their own. It may be a 457 plan, it might be a 403B plan. So check with them, but the enrollment would be through your employer, because we wouldn't be administering those plans. Okay. Any state employee will have our 457 plans. Some political subdivisions might have our plans. All right, saving early. This is just a neat little graph that shows I'm investor A and I began saving at age 30, and I've been putting $1,000 per year in for 10 years. And so I can see that if I'm looking at the blue, I've been putting this money in at age 65, it's grown to 62,000. That's the compounding effect. Now, what if I waited till I was age 45? Well, I'm going to be putting money in, and you can see that the result is less funds because I have, that investing early really helps the money to compound. But that said, it's never too late to start. So what if we weren't, savvy in our 20s and 30s and put money away? Start now. You can never hurt. Okay. The next thing we're going to talk about, and by the way, again, we have tons of YouTube videos, and so you don't have to listen to me yak, yak, yak for an hour. Some of those are only like 20 minutes long, guys. They're nice small bites. But this is one that we already have a video on, and this is called the Portability Enhancement Provision, or PEP. And this is how our defined benefit plan or main plan works together with a deferred comp plan, okay? So here's the deal. If we look over to the right, we can see the 15.26% of the gross earnings. That's the contribution. You may remember a few slides back where we said 7% is going in your bucket, 712 is going into the employer bucket, and if you're in a tier 1 or 2, 1.14 of this 15.26 is going to fund your health credit. This is how we distribute the funds for your defined benefit plan, that lifetime annuity, the money that never runs out, okay? If you look at your left, this is a demonstration of how PEP works with your defined benefit plan. So if I am in year 1 of employment and I'm putting, a minimum of 25, I would encourage you to put at least 1% of your gross your first year into your deferred comp plan. Look what happens. Still 15.26, but we've moved one of the percentages from the employer account over to the employee account. Still all adds up to 15.26, but we're redistributing 8% into your account balance. If I'm in year 2 and I'm putting 2% in, then I'm going to get 9% in mine. I'm reducing the employer. If I'm in year 3 and I'm putting at least 3% in, I've got 10% in mine. Finally, in year 4, if I'm putting 4%, I've got 11% in mine. Now, here's what I like to make really super clear to people. Remember, when you retire with us, we're going to drain this bucket first, okay? And then when that's gone, we're going to move over and pay the rest of your life from this general pool of funds, okay? So really, if you live a long and happy retirement life, it's just going to take us longer to get through your bucket. But some reasons that you may want to choose to do this is, let's say that you have no intention of retiring under this plan and you just want to get your bucket full because when you leave, you want to do a refund or a rollover. Let's say that you have every intention of retiring in this plan and you pass away suddenly, and let's say you're not vested or you're not married, you've got a bigger bucket for your heirs. And then the other reason that this is a good idea is because, like in those slides previously, when you put money into your deferred comp, you are lowering your taxable income on your monthly paycheck, and you're also setting up another retirement distribution stream. So there's lots and lots of good stuff. One more thing is, if you chose to buy service, you could use money that you've put into your 457 plan and roll it to us to buy that time. So you're getting lots of use out of that money. You're using your deferred comp contribution to lower your taxable income. You're taking advantage of PEP, where we're putting more money into your account, and then you turn around and use that money again to buy time. I don't know if you can use money that much normally. It's pretty cool. Okay, this one is the same demonstration, but I want to show you tier 3, because remember, we're missing a bucket. There's no health credit. So we've got the 15.26, still 7% in your member account, but the 1.14 that was in the retiree health insurance credit, it's been lumped in with the employer account, okay? I'm in my first year, I'm putting 1%, boom, 8% goes here, second year, 9%, third year, 10%, fourth year, 11%. So it's the same It's the same magic, sparkles and unicorn. It's just that there's one less bucket. Okay, member self-service. Again, I know I've talked about this a lot, but it is such a neat tool. If you have not created a member self-service account, please do so. If you have one, then go play, because there's lots of cool things you can do out there. You can, oh, by the way, you can update your address. You can enroll, update, or view your benefit plans. You can schedule an appointment with us. You can, if somebody were to pass away, one of your dependents, you can report that death. You can view your retirement account balance. I want to make sure you understand, when you view your account balance, it's your account balance. You're not seeing the general pool of funds, because that's a big old pot of money from all employers. You can do a benefit estimate out there. You can perform service purchases. I just really want to encourage you to use this tool. Okay. Other NDPERS benefits. I'm not going to go into a lot of depth on these, because on our YouTube channel, we have like 10-minute snippets that our insurance managers done, and they're really good. But I want to just bring to your attention that we have them. So first of all, flexible spending. If you're a state employee, there's flexible spending accounts available to you. That means, if you're not familiar with them, that you can dedicate X amount of dollars each year towards, and it comes out of your paycheck pre-tax, and then you can, then you submit claims for eligible expenses. For example, with Medical Flex, let's say I did 1,000 or 12. Let's make the math easy for Marcy. $1,200 a year, and I'm gonna I go to the doctor and I have co-pays. I have a prescription. I have to pay something out of pocket. Maybe I don't take out dental insurance, so I'm going to use my cleaning. I'm going to use that. I have an expense for cleaning and stuff. Medical Flex it's a reimbursement for eligible medical expenses. There's also something called a dependent flex account. So if you have kids in daycare, you can put some pre-tax money aside for that as well. We have an employee assistance program. I don't know how familiar folks are with that, but it is pretty neat. It's for you and any of your dependents that are eligible. You can get X amount of counseling sessions. It could be for, it could be for work-related thing. Um, it could be for money-related matters. It could be for family issues. It could be for substance abuse. It could just be because you're finding the world to be a little stressful these days. Anyway, take advantage of it. We have a Dakota Wellness feature, which means that you can have a gym membership and you can get $20 paid, reimbursed to you for that. There's lots of other cool things you can do online and log points and receive funds. We have Livongo for diabetes. We have a healthy pregnancy. There's a tobacco cessation program out there. And we also have a diabetes management program out there. All this stuff is on our website, guys. I really want to encourage you to go look at it. So I kind of reviewed the flexible spending accounts, but let's take a little bit of a look here. This year, Medical Flex account, and by the way, the IRS decide how much it is. And this year they've raised the Medical Flex limit to $2,850. I know when Medical Flex accounts first came out, I was a little bit leery because it is a use it or lose it, okay? But I have found that I blow through this money pretty fast and wish I could do some more. But you just need to incur the expenses within the year, and then you can claim them. If you're on a high deductible health plan with a health savings account, though, you cannot participate in Medical Flex. And then, as I mentioned previously, there is a dependent care savings account is $5,000 maximum. So here's an example of why someone may consider the health savings accounts. So let's say that between my medical and my dependent, I'm doing $2,000 for medical and $5,000 for dependent. We're back to this thing where, look at, my taxable income is less when I do flexible spending. So my tax burden is less, and then therefore my net income is greater. So that's a reason to think about doing some of these pre-tax savings plans. All right. Again, and I know I've mentioned this throughout, but I'm going to even show you where these guys are at. We have a ton of information about these active employee benefits and also other things that are out there on our website.